Hey everyone, so in today's video, I'm going to give you kind of a beginner kind of idea of a video when it comes to investing. So basically a video about what I would personally do with my first $1,000 if I haven't already invested a lot of my money. So if I was just starting to invest and I had $1,000 to invest, that's what we're going to be talking about today. I'm going to start a little bit more conservative at first, and then we're going to get into some more riskier situations. All of these are great options, so let's get down, let's check these out. Okay, so the first most conservative thing that you could do is just invest the whole $1,000 into an index fund. For example, SPY, which is on the American stock market. Basically, this mirrors the S&P 500, also pays you a dividend as well. It's a great option. Now, with people like Jim Cramer, he has always said that the first $10,000 that you ever save up, you should just throw it into an index fund, and I don't disagree. Personally, this would be my personal route if I was starting over again. The reason for that is because with an index fund, you're going to be mirroring the market. The market historically has always gone up and generally goes up an average amount of roughly 8 to 10% every year. Again, some years could be less, some years could be more, but that's generally where you're sitting at. And over the years, if you reinvest your dividends, you're going to be pretty well all set when it comes to your retirement, let's say, for example, in 30 or 40 years. This also has a lot of volume, where the average trading volume is around 71 million shares. As we see, the last day that this was trading at was at 173 million shares, which is absolutely ridiculous. That's a lot of shares. It is currently giving you a 1.5% yield, which is that dividend. So, for example, if you were to stick $1,000 into this ETF, you would end up getting back 1.5% every single year, which is roughly around $15. Now, that may not sound like a lot, but when you start reinvesting that money over and over and over again for 20, 30, 40 years, it actually starts to add up and will give you a better source of income into the future. And of course, Mr. Wonderful himself has even said that the best returns on the market over the past 60 years are from dividend-paying stocks, which is why O'Leary funds exist. And of course, he's not wrong. They have returned the most amount of capital if you reinvest your dividends. I personally don't reinvest my dividends, but I technically do at the same time. I will take my dividends from TD and stick those dividends into another company so I can be diverse. So I'm still technically reinvesting. And we can see a fantastic example of this here. 5 years ago, this ETF was trading just above $200 per share. It is now sitting at $376. Of course, there was that downturn from the fantastic COVID virus, which if you invested down here, you would be extremely happy and had a lot of returns and happiness. Maybe not so much happiness here because of the virus, but generally financially you would be happier. And this will hold the exact stocks as you would see at the exact same percentage as they are on the stock market itself. So for example, Apple is the largest company in the world, sitting at 6% of the American S&P 500. Then there's Microsoft, Amazon, Facebook, Alphabet. If you're just starting off, Alphabet is Google, YouTube, that kind of a thing. Tesla, which is my personal favorite right now, and we may be talking about that later. Berkshire Hathaway is another fantastic company, and then we have a medical company and a bank. I love banks so much, and I'm not being sarcastic. I really love to invest in banks. Now, the secondary option is just a bit more, I would say, risky. It's not necessarily the most riskiest option that you could possibly take, but it is an ETF. It is technically an index in my opinion because it only holds high dividend paying stocks. However, this is high dividend paying stocks on the TSX, which is the Canadian stock market. So let's get down and let's check this out. It may be a great option as well. So it is currently trading at roughly around $36 per share, depending on, of course, the day you're looking at this video. And the dividend on this one is extremely high because it is a Canadian high dividend yield index. VDY is the ticker. And from there, it's 4.59% dividend, which means that if you were to invest $1,000 into this ETF, you would end up getting $45.90. So a little bit higher than that $15 that SPY was paying you. Now, the idea here is you are getting a bigger dividend, which means if you reinvest it, it's going to be looking a heck of a lot better. There's also something special about this ETF as well. Of course, the volume is really good. You want volume higher if you want to get in and out easier. The expense ratio is also something to look at with ETFs. SPY is 0.9% or 0.09%. This one's 0.2%. SPY is 0.09%. And when you look at the expense ratio, that's how much they are going to charge you for holding your money into their ETF and investing your money for you. So for example, at 0.2%, if you were to invest $1,000 into that ETF, they would literally take 20 cents from you every single year, which is not a lot considering that you're getting a $45 dividend, right? Now, something about this one is, yes, sure, you are getting a bigger dividend, but you're not getting as big of growth as you would be with SPY. So even though this one's just slightly more riskier, but it is paying you more money, it doesn't have as much growth. As we can see here, just around $28. Currently, 5 years ago, currently trading at $36. So it still has some great growth over that 5-year period. And of course, it did top out at a lot higher than it is right now, around $37-ish, but that's still not that bad considering that you're getting all of that dividend growth. And also the fact that if you're reinvesting your dividends, these increases are much higher. Now, going with the whole idea of banks. Remember how I said I like them? Well, guess what? Royal Bank, TD, Bank of Nova Scotia, BMO, CIBC, all banks. Then there's Enbridge, which alone is a 7.5% dividend if you were to invest in that and not the ETF, which is a lot more of a riskier option. But for example, Enbridge, which does pay you a 7.5% dividend, if you were to invest in that company for $1,000, you would get roughly $75 a year in dividends. And why I like dividends and why I have my own trading philosophy when it comes to reinvesting, you never reinvested in the same company, reinvested in a different company, is obviously diversification. But also, if you needed that money, for example, you may have been out of work, then at least you're getting a couple of bucks from when people are sick with COVID, for example, and at least you're getting a couple of bucks in. Now, the most riskiest option is Tesla, and this is the one if I was to be risky. And of course, if you don't have to worry about $1,000. So for example, if it's your first $1,000 and you've got enough money in the bank to last you a year or so, or 6 months, or whatever it is, and you haven't invested any money, this is your first $1,000, then Tesla would be a great option. The only issue with Tesla is it's got high short interest, which means there's a lot of people betting against the company, but it's got such a high chance and just ridiculous promise that it's going to be a massive company someday, that this company has already 10x'd over the past year or so. It could technically 10x. Again, I don't think it will. I think it may double this year, but from the point it's at right now, that's high growth. You could easily make $1,000 this year from your $1,000 investment, but you'll also have to remember that when you're taking riskier bets like this with your first $1,000 that you're investing, that you have to understand that, hey, if there's a huge market decline, stocks like this are going to get hit first, and they're going to get hit the hardest first. They might come back first. They might come back faster, like obviously Tesla did last year. But this is a risky option, but could pay huge at the end. High risk is high reward. Does not pay a dividend. But again, I personally feel that Tesla is the best growth chance for this year. The PE ratio is $971, which means that, yeah, their stock price is very high. They would say that this would be classified as overvalued and that you should sell. But I'm not saying that myself. Of course, never trust a random person on YouTube. Always do your own research. But 60 million shares traded, 40 million average, you're going to be able to get in and out quite easily unless you're probably trading with Robinhood, maybe? Who knows? Anyways, so I hope somebody got that joke. And as we can see, over the past year, it's gone from $100 to $900, and then it's declined back down to just under $700, close to $600. So it's had one heck of a ride. If you invested $1,000 back at the beginning of 2020 and you were to have the money still invested, you never sold it, the top would have been your $1,000 would have turned into $9,000, and of course if you still held it today, you would currently have $6,210. So this would have been a fantastic option for your first $1,000 invested if it was January 1st, 2nd, whatever, of 2020. But again, yes, very risky. It is making more money. Their revenues are going up. Their earnings are going up, which is fantastic. They are not just a car company. They make cars. They make trucks soon. They're also making batteries, which there's probably going to be a battery shortage at the end of this year, maybe early next year. And they also make solar panels and a solar roof. So I personally think with the Biden administration in and all of this new green technology stuff that needs to be flooding the market, I think that they are in prime position to be able to do that. Anyways, these are my own opinions. Remember, always do your own research. Contact qualified professionals if you have any questions. And of course, I'll see you guys in my next video.